Need to unmute first. Sure, Marty, thanks for having me here. It's great to be here. Sorry I can't be in Austin today, but wish you all well and hope you all have a wonderful conference. Really appreciate your program, putting these together, and it's always a joy to be with your group, Marty. Talking about the economy may seem kind of boring, I guess, compared to banking right now, but usually it's the other way around. Starting with Commerce Street, just so you have a little perspective, we're the largest independent investment bank in Dallas. About half our business is non-banking, oil and gas, real estate, technology, fintech, healthcare, manufacturing, you name it. We do manage money in the institutional sense. We have outsourced CIO, outsourced private equity, private capital, hedge funds. We're the fastest growing 401k provider in Texas. We have about $2 billion in the SBIC program, and we manage private capital, right now private equity funds in the banking sector. On the deal side, in the core business of Commerce Street when we first started 20 some odd years ago was in the banking sector, and it was as an advisor to banks, M&A, capital raising. We've been number one in Texas and the Southwest for 26 years, top 5 in the country. So that's the perspective. Our firm is full of investment bankers with expertise in that, investors in that, credit people, ops people, lending, regulators, et cetera. So banks are kind of us, and a lot of us are sort of scratching our head going, do I have enough energy to go through another bank cycle? We seem, but we'll see. We don't know if we got one here or not, but it doesn't look good as this weekend. So let's start a little bit with the economy. First of all, I don't know how questions are done here, Marty, but since we're going to do so much on the banking side, if there are questions, if they want to take them along the way or at the end, whenever you want to do it, I'm not married to any script. On the economy, you can get economic outlook from anybody. So, but maybe some of the things of note, on Friday, we had 311,000 jobs reported above on the growth side, above the 205 expected. That was interesting, a little problematic for the Fed, right? The participation rate increased, problematic in that, they're trying to raise rates. So they want to see this. It's problematic until they see unemployment go up. Unemployment was higher, 3.6 versus 3.4. Wage growth is getting a little stickier, which is what they want at 4.6 currently. It's been averaging about 4.8. Big day tomorrow, CPI, right, coming out. So we'll see on that. The Fed's got to do what the Fed's got to do, and it's got to fight inflation no matter what it does to banking, no matter what it does to venture, no matter what it does to the economy. Inflation is enemy number one. And I think people forget that when I see pundits and whatnot getting on and complaining about the Fed. Don't complain about the Fed. They got to fight inflation. Yeah, they were slower to the table to recognize it, but that's what they got to do. And a banker is not in the rate betting business. So a banker that complains about rate hikes is like a golfer complaining about the out of bounds markers when he hits it out of bounds. Okay. Banks are in the spread business and they should manage accordingly. It's not super hard to do, but amazingly, a lot of banks have forgotten how to do that. We'll get into that in just a minute. I want to focus a moment on earnings, corporate earnings. Let's focus on S&P 500. Currently forecasted earning estimates are about 226 for S&P earnings for the year. That's way too high. It needs to be about 200. They've been cutting estimates like crazy. If you know how analysts cut earnings, they do it in the next quarter and not in the far end. So it looks kind of ridiculous. I don't know if I can share something. Maybe I can. If I can, I'm going to do this right quick, just so that you get a look at it. I think it'll be more helpful to you. Here we go. So this is the analyst estimates. And if you can see on here, the dark blue are the actual numbers. So we peaked in Q2 of 22, and it's been coming down ever since. And look how low that first quarter is. And look how at Q2. We're supposed to have a big old jump in earnings. Where's that coming from? And look at the rest of the year. It's just totally unrealistic. I think it ought to be closer to $200 for the year. and not what they have here. So the market, and as of today, the S&P is slightly down for the year, but the market has multiple expansion for the year on the S&P 500. So I think there's a lot of overvalued risk in the market. You're starting to see that in the VIX. It's crept up to 24 or so, at least on Friday, maybe even higher today. But estimates are what drive everything, right? Estimates and rates and discount rates. And I think that's a good place to start with the stock market and the risk in it. Now, I think we ought to talk banks, and let's focus on that a little bit. Yes,
Dory, can I just get you for 1 second? Are there any?
Oh no, you cut out again. That mic is.
I'm in microphone hell right now. Are there any questions about the economy here, and any thoughts about these projections that Dory was showing, or things like that? Or okay, great. Keep on going, Dory.
Okay, yeah. Before we probably oil, because that's such a big driver of the S&P right now. And so real quick on that, definitely watch oil. It's been a stepchild capital wise, but these companies are doing really, really well. And there is a long-term infrastructure problem on the supply side. It's big, okay, and they've been capital starved. So when that kind of matches up with the markets keeping oil down right now because of short-term demand drop forecasts due to recession or whatnot, but when that starts to catch up, look for oil to kind of get really expensive, and that'll be interesting. So that's a little perspective on oil. I'm not sure it's different than any other oil expert out there. I think there's a lot of consensus on that, but I really don't see that changing. And there's some really great oil investing to be done out there, both in the public and private side, because everyone ran from it. And where did they go? They ran to SPACs and they ran to technology. And my guess is they'll start wandering back to oil slowly because of ESG, conflicts with whatever, depending on where you get your money from.
Dory, just a real quick comment on that. I think with regards to oil, there's like a kind of a baseline usage of petroleum that's necessary just to go into your daily living products. And I think it's around 10 to 15 million barrels a day, right? So my other question about petroleum, obviously there's seismic global macro news, which is this peace between Saudi Arabia and Iran, which was negotiated by China this weekend or the last couple of days. So I don't know how that's going to impact oil, but I imagine it's going to strengthen, OPEC.
Yes, and that's been the discussion as of late, that OPEC will get stronger. But what do we know, just basic history on cartels? They cheat, they disagree, they lie, they don't get along. And so cartels don't work over the long term because of that. They're all, at a minimum, they are fluid.
Fantastic. Let's get to banking.
Yeah, correctly. All right, so banking. Let's kind of do the summary version real quick. Yes, Silicon Valley Bank failed over the weekend. State regulators took over the bank. They closed Silicon Valley Bank. Silvergate closed voluntarily. Silicon Valley Bank failed. You had early last week Moody's come up to them and say, "Hey, we might have to downgrade you." Boy, talk about too little, too late. It'd be nice to be a ratings guy. Marty, you were talking about 2008. They sure missed the boat in 2008. Maybe some of these people at Moody's and S&P ought to go try to be weathermen where it pays.
Dory, it's like being a ref in the NBA.
Yeah, I mean, give me a break. It's really crazy. And we'll get into some of these mistakes, but basically this bank failed, and then Signature Bank. So let's talk about some of the mistakes. What happened, right? So real quickly, this is a bank that focused on one industry, tech and VC, and that's what they did, right? Okay, so we've got three contagion circles here that are created. One is the the funding for VC and a lot of the tech kind of dried up, or at least slowed up. Okay, so that we got a cash problem. Two, we had the cryptocurrency SBF, FTX blow up, and so that's two bubbles. And then we have this bond bubble that we've had, you know, that the with the low rates from the Fed for a long period of time created. But there was a lot of errors created here. Let's start with management. Some of these are I'm going to blame the regulators as well, and perhaps even investors. But the first mistake that's real clear is asset liability management. This is not a new lesson. You know, we learned this in the S&L crisis, at least some of us did. I started in asset liability management in S&Ls back in the 80s. Guess what? You don't fund long-term assets with short-term liabilities in a rising rate environment. It doesn't work. Period. You know, now for 35 years, the average duration of a bank portfolio is about 2 years. And you look up today, and a lot of these banks in their bond portfolios of 6 years. That's where the 6+ years for Silicon Valley Bank, reaching for yield. That's a horrible mismatch. That's 3 times longer than a 35-year average. It's crazy. And they're not the only banks to do that. There's a lot of banks that have done that. Then you factor in accounting rules, FASB 115. I protested against that vehemently in the 90s when they came in. It's a stupid accounting rule. It only marks to market part of the balance sheet, whereas banks aren't in the securities business. They're in the spread business. So I don't know how you can mark to market one part of the balance sheet and not the rest of it. It's all or none. And that's the way banks should be done. That's the way they were done. But FASB, in its infinite accounting wisdom, and I'm a CPA as well, decided against that and thought it was a good idea. You know, I guess making a Wolverine a house pet would be a good idea too. And that's exactly what happened. So banks get hamstrung by putting securities in different buckets. You have a trading bucket where it's marked to market against income and equity. You have an available for sale bucket, which is not marked against income, but is marked against equity, and hold to maturity, which is not marked against either. But the economic gain or loss is still there, right? It's just whether it's recognized. Now, regulators didn't necessarily agree with FASB either, and so they have a different set of rules than FASB. But what it does is it hamstrings the bank. If you have something hold to maturity, you can't sell it, or you have to mark the whole portfolio to market. And if you do too much trading and you're available for sale, then it's social trading, and the same thing hits your income statement. So it's a crazy rule because we don't mark to market the loans or the deposit. But anyway, it is what it is. And that it's almost like dealing with the out of bounds marker and hitting the ball out of bounds. So you have to manage accordingly. You don't just go out there and load up on long-term bonds. The regulators have addressed that issue a little bit with their funding facility that they created, where you can go to the Fed, you can borrow money on your securities portfolio. Even if you got a loss in it, you borrow at cost. So you have $10 billion, let's say, of treasury notes. You can borrow it at $10 billion. You don't have to do it with net of loss. And then, you're fine. It works for a short period of time. We are proposing a rule, matter of fact, to deal with this, where banks can sell out of either one of the portfolios, AFS or HTM, and capitalize the loss and then amortize it over time. I spoke about that in Barney this morning. I think it would be a great rule. It would be a way of forbearance for the banks. In addition to, it doesn't cost the regulators a dime, i.e. us taxpayers. And they did something similar to ag banks in the 1970s. So that is a problem that has got contagion in a lot of banks, okay, from JP Morgan on down. JP Morgan had moved $342 billion into held to maturity. Doesn't mean the losses aren't there. Now, another area that the regulators have not been writing banks up on asset liability management. They should. These duration of these portfolios are ridiculous. And in addition to, they didn't focus really hard on the concentration of industry risk that Silicon Valley Bank had. Pretty much one trick pony. Great bank. I love the bank, but I sold my stock about a year ago. It was too concentrated in deposits and risk in one industry, even though I love the bank. And they didn't have enough holding company capital, which is another problem in the industry. Too many people.
Hey, Dory, can I just cut in for 1 second?
Yeah,
there was a question about Silicon Valley Bank's deposits tripling over the last 2 years. Any thoughts on that as well?
Yeah, no, absolutely. They had a whole bunch of deposits, but if you also look, they were bleeding about $8 to $10 billion a month over the last 10 months. Okay, that's a warning sign. So, and in this group, I'll say this. I didn't say it on TV. I think Goldman Sachs was their advisor. Somebody ought to slap them in the face. They did a horrible job, on the verge of malpractice, trying to get them to sell these bonds at the last minute last week, and then do an offering afterwards. No wonder Peter Thiel and everybody said, "What are you guys doing? Why would anybody invest in that?" Everybody run. They should have been raising money all throughout the year when they saw how fragile this deposit base was. What were they doing? They needed the capital. Their holding company capital ratios were low. If you'd have marked to market the held to maturity portfolio, all the capital would have been gone. Okay, so that loss is there whether you realize it or not. So it should at least be a what? Red flag? Maybe a yellow flag? Something. So no, they didn't raise capital because what? They didn't want to get diluted. We're a great bank. We don't want to get diluted. That mentality right there exists in most of the banks out there, from JP Morgan on down. These money center banks don't have enough capital at the holding company level either. They're running close to 5%, whereas in 2019, they were closer to 8 to 10%. Our industry was rock solid from 2010 through 2019, better than it ever was in history because of those capital ratios. And then the banks kept growing, and they expanded, and the regulators let them grow at the holding company levels. And I brought that up in the last conference you had, and you were nice enough to let me speak at. So I was at a regulator conference in Florida there in Palm Beach a month ago. And all the regulators were on a panel, and I got up and brought up this issue, and they all dismissed me, all of them. Oh, well, the bank levels are solid. And I had one of them come up to me afterwards and admitted to me that it's going to be a problem. And of course, it was the state banking commissioner, Charles Cooper, a good friend of mine, who's been through enough cycles to know better. The banks look to the holding companies as a source of strength. And that source of strength comes from two areas. One, the capital that it has, and two, the capital that it has the ability to get. Okay, and guess what? Silicon Valley Bank could not get any more capital, and they didn't have enough to begin with. And that's the problem. And so I think that kind of contagion could spread out there, but the first thing they got to do is make sure the depositors are safe. So there's different perspectives on this. One from the depositor. You know, Peter Thiel comes out and tells everybody, "Hey, I'm the smartest guy in the room. Everybody leave the bank." First of all, he committed a federal crime by causing a run on a bank. They ought to go after him. And as a taxpayer, I hope they do. Can't do that. Two, Peter doesn't know anything on that issue, not on the depositor side. Why? Because the federal FDIC has not failed on a deposit, insured or uninsured, since its creation in 1934. Okay. Even what they thought about it. They thought about it once. The uninsured portion with WAMU, it came out in the paper, and they lost almost 17 billion in deposits in 10 days, and the bank failed. Thank you very much, stupid regulator, for saying that, because that cost us a lot of money as a taxpayer. And I'm sure TPG is not real happy either, because they lost 1.25 billion in that deal when it failed. But they didn't analyze the assets correctly either. They underestimated. Now, WAMU.
Dory, some questions here just from the audience. You know, so by guaranteeing this deposits, of which I guess 95% were not covered by FDIC insurance, is that establishing a precedent that shouldn't be established? I mean, is this a slippery slope? Or?
Yeah, we need to talk about that. You know, I've been getting that question all day. Well, what about moral hazard? We got to get moral hazard in the industry. Can we really afford to backstop all the deposits? Okay, I'm all about capitalism and free markets. Okay, but you got to ask you, not on this. You don't want moral hazard in deposits. You want it in the investor side. You want it in the debt side. okay, not in deposits, or else you wind up with a Great Depression. You know, you had lines around the weekend. I had people calling me from LA and Boston, people lining around the block thinking the First Republic was going to fail. It wasn't going to fail. They got the Fed protected them. Everything is okay. Even if it failed, what you want as a society is that bank and depositor to be protected. So you don't have them all go take the money out and stick it in mason jars, because then there's not enough. Then they have to cover the hole with the assets. And that's a bigger hole and a bigger cost to us as taxpayers. So it's a business decision. It is less risky for us as taxpayers to cover all the deposits and make sure that we don't introduce moral hazard into the deposits than it is to introduce it and run the risk of a Great Depression and trying to fill the hole. You think we had an inflation problem before, then we've become Venezuela, right? We spent $2.5 trillion in 2008, over 10 trillion in COVID. Imagine what the price would be if we had to bail out the whole and pay off all the losses in the banking industry that we caused on a massive deposit run.
No, yeah, thanks, Dory. I think that our perspective is it's kind of similar to Spain. If we started bailing out all the banks, right? I think that the main bank of Spain has gone under like 3 times in the last 12 years, right? So,
yes. So I mean, if you think about it, the cheapest way to deal with a banking crisis is to guarantee the deposits. And then we create a bridge bank, move it over, everything runs the same, and then we sell the bank to the JP Morgan or somebody else and let them take over and assume the deposit. That way the funding mechanism stays in place. We've got deposits, we got assets, it all stays in place. All we have is an equity.
We're going to get to the discussion more. I think it's morally correct, and somebody explained over the weekend that the assets plus deposits that SVB had could make everybody whole, you know, once the asset sale was complete. So that's one thing. But there's more questions in the audience about
SVB. Yeah, there may be a gap, but you got to remember there are a lot of. You can pull it up. They've got a lot of entities at the holding company level and debt at the holding company level.
Yeah,
so
yeah, too many entities
at the holding company level get sold, and then what? They are first in line to fill the hole for us as guarantors of the FDIC. You got to remember the FDIC has a fund to begin with.
Yep. So more questions. What about Ally Bank? Any thoughts?
So if you're going to ask me about specific banks, I want to be real careful about that, okay? Because I don't want to put myself in the Peter Thiel. I got this question.
Okay. So let's talk about Ally then.
I think could fail. Yes. Are there banks out there that have OCI issues? Yes. Are there banks that have hotter deposits run risk than other banks? Yes. And you run from them. Okay, not a good time to be in them. But like I said, I'm not even buying banks that I like right now, because even though they're cheap and even though I love the banks, I think there's the market's just going to throw the baby out with the bathwater, because the market is not very good about analyzing bank capital ratios, the asset liability mismatch, the deposit run risk, the industry risk, and we haven't even begun to deal with possible coming credit risk. And hopefully that doesn't happen. But if the Fed and the regulators do a good job here, I think they can stave off a bunch of credit risk, because at the bank level, banks have been underwriting pretty well. And they do have a lot of capital at the bank levels, but it's just a little different kind of problem.
Any thoughts on Silvergate? The stock is still at $2.50.
Yeah, I wouldn't touch that. We used to be the largest investor in Silvergate. Okay. And so in 2000, I don't know, pick a year, 16 or so, they started flirting with this crypto deposit thing. And we're like, that's a little different. So we sold in 2018 as it became a bigger and bigger concentration risk of the bank. While it was 10 to 15%, I was fine with it. It was novelty. It was a pretty good way to get deposits, but it was getting too big. So we sold out. We made 3X. I thought I was the stupidest man in America for a while, because Kathy Wood and everyone else discovered it. And at one point it was trading at 30X of my original investment. I thought, good gosh, I'm an idiot. But I don't feel that way anymore. It just kind of came to pass, and there's probably a good chance I couldn't have timed the exit anyway. So we'll take our 3X and go. But Silvergate, no, I'd stay away from that. You don't want to catch falling knives.
I have more questions from the audience here. So this gets back to guaranteeing all deposits. I mean, some of these deposits were pretty significant, right? I mean, there was a breakdown that came out on Axia this weekend, and JP Morgan had their note that they had published about the risk in Silicon Valley Bank. So the question here is, are you suggesting FDIC should make deposit insurance unlimited?
They've de facto done that, right? Because
terrible. It's terrible.
Money, any deposits in the 80s or in the 90s or in the 2000s or in 2008 crash. Okay. So they're not going to, you might go, well, why don't they come out and say that? Well, there's no need to. If you kind of know what you're doing, you understand it. They do need to come out and there's so much misinformation out there. I mean, over the last few days, I kept seeing all this stuff with, they're not going to pay for these deposits. They're not going to do this. They're not going to do that. And all that does is create the fear and run risk. But you sort of have to let it play out. I'm sure there were some people. Now, Janet Yellen, I'm critical of her because she's an economist and not a banker. And so she didn't come out and say it. But she should have come out and said, the depositors are going to be okay, because they were forced to. Yeah, how the end game's going to get there. They just have to get there. And so it took them 2 days to get there, but at least it was faster than the 10 to 11 days that it took them on one move.
Are crypto companies that put money into SVP liable for putting it into SVB when they knew that SVB was losing money for 10 months straight? That's a question from the audience. I'm not going to name the crypto company.
So if you're talking about a company, like I noticed Roku had a ton of money in there.
There you go. Yeah, Roku.
Yeah.
Yep.
If you're talking about companies having concentration risk and dealing, I've dealt with this, the last 3 days like crazy. And you shouldn't have one bank. You should have multiple banks. And not just because maybe it'll fail, but they may wake up and not like you one day. It happens. Hey, move your business. Well, I'm not prepared for that. I'm kind of busy. I've got this going on, that going on. You should always have multiple banks. In addition to that, can have them compete against each other, right? So concentrating all your deposits and your business in one bank is just foolish. That's bad management to begin with. I don't know why anybody would do that, but it's amazing how many people do that. And there's a lot of companies where
Dory,
Silicon Valley Bank kind of requires you to do all your business with them too.
Yeah, that sounds like that's going to be stopped. That's not going to be allowed to happen going forward. So
jump on that.
Dory, I guess that the SEC is kind of investigating the venture capital business, so to speak. I mean, and they have an ongoing investigation of the two of the largest players in crypto as well. So, do you have any thoughts? I mean, it seems to me that there's a question about venture capital and their ability to do diligence versus being a kind of FOMO investment product, fear of missing out product, right? And then on the top side, it's mismanagement of the capital once they have it by putting it in concentration into one bank, right? Any thoughts on that?
Yes. And, I've had a bunch of VC funds and people calling me over the weekend. I said, first thing you need to do is disassociate yourself away from the industry, because you're going to go to a new bank and he's going to say, I don't want you. You're bad goods. Look what you did. You caused that bank to fail. You run when you get scared. You weren't loyal. Somebody tells you a rumor that you're not going to get paid back your deposits and you ran for the hills. You're a bad customer. I don't want you. You got to realize if you're a VC fund, somebody may not want your business. Okay. You're going to have to change. You're going to change your behavior. You're going to have to go, you know what? Deposits are covered. And if I come into a bank, I'll stay there. Your business is going to be fine. Even at Silicon Valley Bank, you're going to get your money back. You're going to move over to the Bridge Bank, and then they're going to move you into somebody else. Okay. Now, having said that, is a lot of people are going to disagree with me on that. Well, wait a minute, y'all got a responsibility to move and this. That, that. I don't have any problem with that, but I have multiple banks. And if you want to move because you think a bank is risky, that's fine. Guess what? I do it too. Okay. But you can only expect so many people to really know and understand banks. And guess what? Even those of us who know, we still make mistakes. Okay. I missed some in 2008 from Contagion. They were great banks. They got pulled down for other reasons.
Hey, Dory, there's a whole question about the impact of SVB's failure on non-USA venture capital. So did you hear that, Silicon Valley Bank's London branch got bought out by HSBC this weekend?
Yes, I did. And they got a really good deal.
What was the price again?
A very little, almost nothing. Now you got to remember, if they assume that business, they got to put in capital, right, for a capital requirement. So it's kind of like when JP Morgan paid 1.8 billion for WAMU, you'd think they stole it for a $300 billion bank, but they had to add 9 billion in capital. So the true cost was, 10.8 billion.
Yeah, but that's factored over the cost of acquiring customers, right? I mean, that's always the case because it's so expensive for financial firms to acquire customers. But the punchline is that HSBC bought Silicon Valley Bank London for $1.
Yes.
There you go. Right. So it's very interesting. We got like 4 more minutes here. Do you have any more comments? I mean, what are we missing, and what are our thoughts going forward on the banking industry? This is not the end, right? This is just the beginning.
And I would say you're in a race and the yellow flag's out. We've got a couple of car crashes going on here, and we're not sure if a few other people aren't going to hit them too. Okay, slow down. Keep your money in cash. You're getting paid a lot for it. Stocks are overvalued. You get tied up in illiquid stuff. Expect it to get more illiquid. Expect gates to pop up. Things will probably get up. And guess what? The Fed's been telling us they're going to cause a recession. So is the curve. And I think the market's been just whistling past the graveyard going, let's rally in January and rates will come down soon. They're wrong. They shouldn't be hiking. I don't think the market's quite saying that anymore.
Here's some headlines. Okay. First Republic Bank halted due to volatility. I mean, most of the banks on the West Coast are down 60% today. Pac West halted down to 41%. Regions halted down 31%. Western Alliance halted down 76%.
Yeah, that's fear, right? That's fear. And you need a regulator, I don't want to be ugly about Joe Biden, but there is an element here. You don't have to answer this question in the audience, but think to yourself, how many of you truly trust the government? So when somebody in the government comes up to tell you, hey, everybody remain calm, they're thinking of Kevin Bacon in Animal House, right? So, there's a credibility issue here because the yahoos in Washington are spending our money like crazy and they lie to us every day. So, but I do trust the FDIC and the regulatory system. They're not perfect. They make mistakes. They cause part of this. They get some of the blame. But the failure, the bridge bank process, they're very good at that. And if they took over Signature Bank, by surprise, walk into their offices this weekend, they're on it. It's pretty quick. Back to these banks. There's some really good banks out there. I love Pac West. I sold out a while back because they didn't have the amount of holding company debt that I want them to. Are they extremely cheap right now? Yes. I'm salivating over that bank. That's the best banking franchise in Southern California. And it's commercial banking. And it's a really good bank, very stable deposits, and have been through several cycles. But how many of us can withstand fear and a sell-off like that? That's 1929 type stuff.
I got a question from the audience.
Fear is very powerful.
Sorry, one second. So real estate office. And any thoughts on real estate office banking portfolios? I mean, obviously, I was just in San
We've been talking
Francisco.
about that for the last month. You know, it started in October when the real estate guys finally started realizing they couldn't get equity in deals and stuff. I think I spoke at your last conference, you know, telling them the deals on my desk were cap rates were coming in at, you know, 4 and 4.5% for exits. You know, these guys are, what are they smoking? And throw the deal in the trash. Well, now they're going to banks trying to refinance their construction or their loans and realizing not only cap rates are really high, I don't think I have any equity in this deal. And real estate people don't carry a lot of cash around. So yeah, that's coming. Banks are really, you think they were tightening their credit yesterday? Wait till you talk to them this week.
Right, and I think the key issue here is that as we experience it with Lehman and Bear Stearns, there's so many other shoes dropped, you know, and I don't even think we've hit bottom on crypto yet, right? I mean, just a statement from Janet Yellen that Signature's deposits of 20 billion in crypto were seen to be as, you know, highly volatile. I mean, I think it cast doubt on crypto everywhere, right? So
Signature's a great bank, and this shouldn't have happened to them. They only had about 15% exposure to those kind of deposit, right? But that's enough if you've got the mark-to-market issue in your portfolio, and what, you don't have enough capital at the holding company level. I had actually been working, I can say this now because it's not behind the wall, but have actually been trying to convince that bank to raise convertible preferred for the last year. Oops. You know, everybody thought we've been investing with our private equity fund, convertible preferreds and banks trying to get their capital up. And everybody thinks I'm being predatory. I don't think so now. I think they're starting
Mark,
to kind of need
Mark,
it.
did you have a question, Mark?
I had a comment for you to maybe make you laugh a little bit, but Bitcoin's up 10% this morning.
Good gosh, why? Oh, I know why. They see that. Yeah, there's a whole section of, think about this. There's a whole section of people out there that are going to think Bitcoin is safer than banking. That's the answer. And I guarantee you, you'll have some 24-year-old kid on TV somewhere going, Bitcoin's more safe than banking.
So Dory, I mean, we've got 2 minutes left. So if you were God, what would you do in terms of regulatory framework for banking? That what minor or major changes would you make to make this more sustainable?
So first of all, they need to this liquidity window would probably be bigger than what they have. They need to expand that. That's good. 2, the suggestion we have on changing the rules where they can capitalize the loss and amortize it over time. 3, reassure the public, depositors, your money's safe. Don't worry about it. It's fine. The bank fails, somebody will take it over. You're going to be taken care of. Investors, you may or may not be safe. You know, that's not our issue. Okay, the market has to work that out. But they need to be real careful about this fear in the market right now. And it sure looks like it's showing up in the banks. And there's some really good banks with really good credit underwriting in there. So, you know, I'm going to be slow and cautious on this, but I'm already starting to salivate on some of these. So we'll just see what happens.
Yeah, I've got Peter Plot. Peter, do you have any comments on you know, Peter ran a family office in England and London for a long time, and he knows, you know, the economic system there better than anybody. And any thoughts on what's going on in banking or any questions you may have of Dory?
Yeah, thanks. So look, I've been looking at banks, investing in banks, distressed banks for pretty much 3 decades. So I started my career in the late 80s as a bank analyst and went through various crises. So I agree with everything Dory said. I mean, I think he's probably the best panelist today. There's no doubt. So thank you, Dory. One thing I would say, and just add to his comment about the if you're a depositor, yeah, you should be taken care of in all sense of the word. But if you are in the equity, you're in the junior subordinated debt, trust preferreds, it really all depends on the liquidity of the bank. So shareholders can be wiped out easily, and then you can go into the various different tiers of the capital structure. I mean, just look at the global financial crisis as a great historical track record how the regulators stepped in quickly, and protected depositors while, junior subordinated debt and others could take a hit.
Yeah, I want to make a comment about debt investors, and there might be some distressed debt guys out there, and they all kind of wander in when they see blood in the water, right? If you don't know what you're doing, stay away from banks on debt. There's no assets, okay? It's binary. The bank's either doing great or your money is for zero. There's no recovery of 20 to 50 cents on the dollar or any of that. It's binary. So if you're a distressed debt guy, don't get all salivating about banks, because unless you're a bank expert, and it's just you're asking for a goose egg.
I do have one thing to say about debt or credit, which is, so I got a note from somebody telling me that venture debt will be amazing the next few years because the 800-pound gorilla of the space is gone, right? And a lot of, I guess maybe it wasn't Varney, but maybe Maria Bartiromo this morning was like saying that venture debt is highly risky, but it really isn't highly risky when you're dealing with the creme de la creme of the venture capital space, right? And those guys will now be looking for venture debt. I don't know if you guys invest in that space or look at that space, but to me, you've got the business that was doing 50% of $15 billion of venture debt is gone. So thoughts?
Absolutely agree. And I've been talking to teams of Silicon Valley guys, and I said, hey, don't you sweat it. They're all panicky and this, that, and go, it was a great business that you guys have. I can put you in a dozen banks in a heartbeat, for what you guys do. You had a great business over there. It just needed to be managed. The balance sheet needed to be managed better, and the industry risk concentration needed to be managed better.
So, Dory, thanks. So, I'm sorry, do you have one more question, Blake?
Yeah, I have a quick question. Dory, which companies, which firms, which funds do you think are in a good position to pick up some of these distressed assets as the banks puke them out? I'm not talking about the long-dated treasuries, but
so
comes to mind.
So if you're a distressed guy or private equity guy or whatever, how can I take advantage of this? Now, maybe you can help me with this, because I've just been inundated and I just saw this flash across there. But I think, Apollo had put together a group of people, and they weren't trying to buy the bank. They were trying to buy the other assets of the holding company. Okay.
Exactly.
I thought that was a great strategy. Because someone else had asked me, hey, are these private equity guys going to be able to put up a group and buy these banks? I'm like, that's a stupid idea. And it was stupid back in 2008. No one made any money. None of them. They all lost money except for who? Steve Mnuchin, who turned it into a treasury job, right? At IndyMac. But that was an asset purchase, and he marked the market right. And the other guys didn't, and they didn't do a very good job. So if you're a regulator, you're not going to sell Silicon Valley Bank to a private equity group and still have concentration risk. You'll sell at a lower price to a bank. The other opportunities as far as buying assets, buying loans and stuff, my guess is that's going to be pretty difficult, because that's probably the gold in this deal, right? That's the gold in this deal. And the buyer of the bank is going to want those assets unless they're bad. And if they're bad, okay, fine. But I don't think Silicon Valley had a bunch of bad assets, unless it just hasn't rolled to the surface yet, because some of these VC funds are having trouble or whatever. But, they ran that business a little different. Part of the security for the loans were what? The deposits in the relationship, right, and the equity in the company. So it'll be interesting to sort out. I'm not sure those loans are as valuable on their own without the other ties to it.
Right.
Well, that's fantastic.